Hello and welcome to the spring update on mortgage rates and real estate. I've got a really important message to share with you today. In fact, it's the first in a series of messages I'll be releasing throughout this week with the intention of not only getting you prepared, but really clearing up some of the confusion and fear that I've been receiving and speaking with so many of you about selling or buying a new home in today's market. Some of you want to buy a new home, maybe move up to something that's better for your family, but you're not sure you can afford it. And many of you can afford it, but you don't want to leave that 3% interest rate that you're currently in. It's a real predicament. Some of you are looking to buy your first home, wondering if you can afford it. And if so, is now even the right time to buy, or should I wait? Listen, there's no one size fits all, no static answer to such a dynamic question. We all have different needs, objectives, personal circumstances, and I can't give you a simple answer. Wish I could. But what I can help you do is understand. My intention, my guiding purpose in these videos is to empower you with the clarity that you need so that you can make the best decision for yourself. Yes, we're all affected by different things in our personal lives, but there are some objective things that affect all of us. Things like interest rates, inflation, home inventory, home prices. Some of you are wondering about a recession. What does that mean? And how is that going to affect real estate or my family? As we take deep dives into all these different topics, I'm going to present it to you in a way that I really hope makes sense. If you find this helpful, please do share the message with somebody else you think could benefit from it. I'm really excited to share with you, and I've got a lot to go over. So today we're going to start by talking about mortgage rates. And one last thing, this isn't going to be like a 43-second, TikTok message. If that's what you're hoping for, you can tune off now. I'm really interested in educating people and clearing up so much of the misinformation that's out there. And to do so, sometimes I got to get a little bit technical here in some of these videos. And today, it's one of those. We all have heard this stuff about the Feds raising interest rates like they did last year, and they're about to do it this Wednesday again, potentially as well. So it's important you have a basic technical understanding. So why have rates gone up almost double over the last year? Do you know what causes rates to go up or down? The most common answer I hear from buyers, even realtors, and definitely the media, is that the Feds control mortgage rates. If the Feds raise rates by 0.5%, then mortgage rates go up 0.5%. And while there is a correlation, that's just not how it works.
So the Fed funds rate is a tool that the central bank uses to manage the supply of money in the economy. And when the Fed raises rates, it influences what banks pay to borrow money from each other, which then affects the rates they charge you and me on things like credit cards or installment loans. But let's be clear, when the Fed raises rates, it does not mean that mortgage rates go up. If you look here, you'll see the Fed's raised rates 8 times over the last 12 months, from 0.25% all the way up to 4.75%. And yes, mortgage rates went up as well. It's the cause and effect relationship that confuses people. You see, mortgage rates were getting higher because of runaway inflation, not really because of the Feds raising rates. Now, when a mortgage is originated, that money rarely sits on a bank's portfolio. Typically, it's sold into the secondary markets where investors get paid a relatively low but stable yield of return over a long duration of time. See, as a mortgage company, we get paid a servicing premium to collect your payments, but the actual interest goes to a group of investors who invest in mortgage-backed securities where that money, that mortgage, performs just like a bond. And this is why mortgage rates tend to also do well in times of market uncertainty, because there's a flight of safety to the bond market. So, economic unrest like a recession or global turmoil like a pandemic, times like these are generally supportive of a more thriving bond market, which leads to lower mortgage rates. Because a mortgage is a bond, the best barometer to see what's happening in the mortgage markets is the 10-year Treasury. Now, this graph illustrates the lockstep relationship between mortgage rates and the 10-year bond. you look over here on the right, this y-axis, 1%, 2, 3. As those yields rise, so do mortgage rates. As we entered March 2023, we hit 4% on the 10-year and mortgage rates were around 7%. If we look back to March 2022, you'll see interest rates were around 3.5%. I've drawn a line to track several inflection points over this last year, and this first huge rise in yields began in March, and then we had this torrid increase through October. All this was mainly due to rising inflation. The highest rates got last year was October, around 7.25%, and you can see here our rates came down almost 0.5% overnight. Now, why did that happen? The reason we saw this decline was due to favorable inflation data. And to the point I was making about the Fed rate, this drop actually occurred on the heels of the Fed rate going up by 0.75%. So sometimes mortgage rates can actually go down when the Fed raise rates. Now, one more thing here, which we'll expand on greatly later in the week. When rates went down in November, that ride actually continued lower into December and January. And look what happened. Pending home sales increased in both of these months, with January surging 8.1%, the largest monthly gain since June 2020. And it's not a mystery why. Buyers simply responded to better affordability. When rates came down, buyers entered the market. It's estimated that with every 1% drop, an additional 5 million buyers enter the market. So while mortgage rates are not ideal to our budget, they can also open up opportunity for buyers.
So as we reviewed, coming into March, interest rates were about 7%. The 10-year was around 4. Over the last week, we've actually seen interest rates and the 10-year come down about 0.5%. And this was really in response to some positive inflation data that we received on the week of the 13th. And also there was a little bit of a flight to safety in response to this banking liquidity crisis that's been emerging. Now, the Fed meets on Wednesday, and if they do raise rates, don't freak out. Remember, rates could even go down. Much of that really depends on the language that the Fed uses and the data that they choose to focus on. Now, the rate of interest, it's important. And over the life of the loan, it can have a compounding wealth impact. A mortgage is probably the biggest debt you will ever own. But I encourage you, see it as more than that. A mortgage is also a dynamic investment vehicle. And just like any money that you invest, it's not made to be unattended to. You need to actively manage that money. Look for money saving opportunities through mortgage refinancing or maybe different loan terms than just a 30-year loan. And if you have a 30-year loan, I also encourage you to develop a strategy to pay it down quicker. Even a little can go a really long way and have a far greater impact than a rate itself will ever do. I'm excited to share the next video with you on mortgage rates, on inflation, and why the data shows some reason for optimism going into the spring and summer months. Thank you for your time. I really hope this made a difference.